What is up, guys? Thank you for joining me for another podcast episode. I still live stream Monday, Wednesday, Friday, usually 3 times a week. You guys can go over there and subscribe. That way you don't miss any of my content. You also get to see me and my charts and whatever I'm reading. And you can also join the community. You can ask questions. I can respond to those. It's a good community feeling. So I recommend doing that. Links will be down below. Like, comment, subscribe, turn the notification bell on. That way you'll get notified when I do go live. So thanks for hanging out, staying subscribed to this feed, and I hope to see you over on the other platforms. What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner. Thank you for joining me. Happy Wednesday. Hope your guys' day went well. Live streaming a little bit later than normal, but I am going out on Telegram, YouTube, and Rumble. Remember to like, comment, and subscribe. I'll check the chat before the end of the day. What do I have on schedule for today? Well, we're going to look at the price, look at Bitcoin breakout going on right now, take a look at the stock market, talk through a few things. Then I wanted to read through the recent SLOOS data, the Senior Loan Officer Opinion Survey from the Federal Reserve. This is a window into shadow banking, into money creation in the global financial system. And it's overlooked by everybody pretty much. There's just a few of us that take a look at this and go a deep dive into the SLOOS data. But that's what we're going to do on today's show. So let me share the screen and jump right into it. I'm going to share my screen over here on Telegram as well. Sorry, dudes. All right. So we find ourselves here on bitcoinandmarkets.com, all spelled out. That's the homepage where you can find all my stuff. You can see Bitcoin Fundamentals Report. I write that on Mondays, goes out, and then I do a live stream covering all those topics with my tangents and so forth. There's other member perks, so you can support me monetarily here. And there is a premium tier of newsletter. I haven't written one of those about, I think, going on 12 days now. I will be getting one out very shortly, but the price has been so flat that there hasn't really been much to write on because that's really focused around the price of Bitcoin. Okay, so that is that. Let's just go right into the charts then, okay? So we got the Bitcoin price and this horizontal line. It's back in play, guys. I thought it was going to rip right through this earlier today because it hit, what was the high that it hit? 44,389 on Bitstamp. So I thought it was just going to keep going, blow right through this and start heading up towards this 49,000 again. But this line that we have been watching ever since back here on December 5th, actually we formed it here on December 8th. There's a closing price from December 8th, and it acted as resistance all the way through here, kind of weaved in and out, and now we're back at it, testing it from the underside, 44,193. Again, that is the closing price from December 8th that we were using back during this period in December. Pretty big move. I think this is, if we get above this, because here, let's draw a little rectangle. So this area has just seen a massive amount of volume that when we break out and we go above this, it's going to be very hard for the price to fall back through it. So if we go up here and we test 49,000, I'm going to be fairly comfortable that saying 40,000 will never be broken again. And probably not even this 44,000. But that's what I like to do is every now and then say, because, people, when we pass 30,000 or something, say, oh, we're never going below 30,000 again. You lost your chance to buy below 30,000. I'm pretty conservative in making those calls, but I have made that it'll never go below 30 again. And after this breakout, we might be, it might be time to say it'll never go below 40,000 again. I can't wait for the day that I say it'll never go below 100,000 again. But okay, so that is the Bitcoin chart. Hey guys on Telegram, make sure you're muted. I'm getting some hot mic in my ear. Okay, so let's continue on. Let's take a look at the dollar. The dollar has had a significant move over the last few days, breaking up above this horizontal resistance, going higher. If you guys are new to my content, I was the only the only dollar bull in the Bitcoin content creator community, if there is such a thing. And all during COVID, let's go to a weekly chart and back out a little bit. All during COVID, so starting, where's my arrow? Starting like around here, I'm calling for a strong dollar. Then it sinks down, and all these people are like, "Oh, you're going to take your strong dollar call back? Strong dollar call?" I'm like, dude, it's not even lower than it was back here. Like the dollar's not dying. It was just here 2 years ago, right? And then all of a sudden we get the dollar wrecking ball that comes all the way up here. And I called this to pretty close to the top. Let's get out a Fibonacci retracement. And this is what I did. Drew out from a top, bottom of the last range, and the 1618 extension came up here to 112. And so that's why I was like, 112 is probably going to be at least the stopping point, if not the top. It went a little bit higher. Obviously, you can see that got up here to 114. And I thought that it was going to enter a range, and that is what it has done so far. So hopefully that continues. Where am I looking here? Right here. So this is the range roughly from 100 to 115 or whatever I was thinking. But it looks like it's going to be a lower range, right? Down here. So I'm not surprised. I mean, this is a significant move in the dollar, breaking some of this horizontal resistance. It's looking fairly strong. China's dying. When people say the dollar is going to die, but they don't say anything about the yuan or the yen or the euro or even the pound, right? Or the Canadian dollar or any of these other alternatives, they don't even look at those and say anything about it when the dollar is obviously stronger and better prepared to go forward than those other fiat currencies. Okay. And of course, the way Bitcoin works into that is you can back the dollar with Bitcoin. The dollar has changed its stripes many times throughout its history. It's not like it was gold only, and then in 1971 it wasn't not gold. Okay, it's been at least 3 or 4 times in its history has it changed, and this is the most recent one, and it can change back. I didn't know. I mean, I knew that Michael Saylor had said something about it, but I never seen a clip. But I did just see a clip on Twitter of him saying the dollar will be backed by Bitcoin at some point, and I totally agree with that. That is how the monetary evolution is going. It's going to go away from credit-based money towards commodity money once again, and Bitcoin is just a much better solution than gold. Okay, so that's the dollar. Let's go to the U.S. 10-year. There was a big story for this. Maybe I can pull that up as well. But so 10-year, it retraced all of its losses that it suffered from this collapse out of this wedge, and has kind of gone sideways for a couple days. People were kind of worried about the largest 10-year auction ever, and we have an update from that. So this is, of course, via Zero Hedge. Record large 10-year auction sees stellar demand, first stop through in 12 months. Today's 10-year auction was set to make history. The February refunding auction would sell $42 billion in debt maturing in 2034, the largest amount ever for a 10-year auction. And after yesterday's mediocre 3-year auction, there were some concerns that the sheer size of today's issuance could cause severe market indigestion. Those fears proved to be unfounded because moments ago, the Treasury announced that the record amount of 10-year debt sold in a very strong auction, which priced at a high yield of 4.093%, up from 4.024% last month, but stopped 1.2 bips through the 4.105% when issued. That was the first stop through for a 10-year paper in a year, or since February, excluding. Okay, blah, 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 blah. Let's take a look at this. I like to see these. So the green is indirect bidders. Those are foreign bidders. Direct bidders will be like domestic, but not primary dealers. And then the blue is the domestic primary dealers. And they mainly the primary dealers buy these to warehouse them to then use them in the secondary market. But you can see, since this goes back to the great financial crisis of January of 2009, and the indirects have only grown, and the primary dealers has only shrunk. So people that say, oh, there's not a lot of demand for U.S. debt. Okay, we just had our largest 10-year auction ever, and indirects are taking a majority. Foreign bidders are taking a majority of this debt. There is huge amounts of demand out there in the world for U.S. government debt because, just like the dollar and its competitor currencies, government debt has competing government debt alternatives, right? Are you going to buy a Japanese government bond? Are you going to buy maybe a German Bund, but an Italian? No. British government debt? No. You're going to buy U.S. treasuries. Even those people over there in Europe, even those people in Asia, they're going to buy U.S. treasuries. Okay, enough of that. So that was the 10-year auction. We were talking about that. And here's a chart. So despite the largest 10-year auction ever, where supposedly supply is going up, right? Why didn't we see yields rising? That would be price falling. If supply rises and demand is stagnant or even going down because no one wants our debt, yields should be going up, but they're not. They're actually coming down, as you can see. All right, enough on that. Let's go into oil. Then we'll get to stocks. So oil has made a recovery over the last couple of days, up to $74 per barrel. But I mean, just if you zoom out on this, let's go weekly on oil too. And we have to make this not. And these are just all the cuts that OPEC has had. Let's hide those. This is kind of messy. I'll leave the arrows on there. But you can see we've been bouncing in this range that has formed itself all the way since the beginning of 2022. So really, for how many years is that? Over 18 months, we've been in this range between 90 and 70, in that range. Very few macro analysts that at least I follow predicted this. You know, they were all talking about higher oil prices. They're talking about cheap peak oil. They're talking about the end of shale revolution, yada, yada, yada. And what do we see? We just see oil continuing to, like this. If you look at this whole range, let's do a parallel channel on this. So this range right here. Okay, now let's make the midline show. I'll make it solid. Okay, so where is most of the price action in this range? Is it on the top half or the bottom half? It's on the bottom half. That's where most of the action has been happening, especially if we just go back to like November, but you know, you can count November 2022. This part was obviously the top half of the channel, but most of this has been happening down at the bottom half of the channel, and it's just weak. It's just weak. The price of oil is weak, which is good because that means it's cheap oil. There's not going to be as much, or cheap gas. There's not going to be as much pressure on prices to go higher, and there's no demand out there in the world to push this price higher. And I remember when Luke Groman, he was, I think, mentioning me saying about peak oil demand, which is my thing. And he said, oh, no, there's no such thing as peak oil demand because we have unlimited demand for oil. Well, yeah, but I mean at that price, okay? At a price, we have peak oil demand at any given price. And so the economy just cannot support $90 a barrel oil. When it goes to $90 a barrel, we get economic trouble. And then it bakes in the cake future economic deterioration because we cannot pay for higher gas prices because we just don't have the economic activity right now. So higher oil prices lock in future economic deterioration. So all these OPEC cuts, all these arrows, that's just like causing more headaches for OPEC down the road because it's hurting the economy more than it should be. It won't be able to recover as quickly. Anyways, so that was oil. Let's take a look at stocks. This will be the last one. Oh boy, there's so many people. There's so many people mad about this. So many people mad. Like, how can they think like stocks? How can stocks be going higher if we have all this economic trouble? It must be because the government's spending so much money. Don't I know that the government spends money? That means stocks will go higher. I mean, what's the connection? Is the government buying stocks? No. Is the Fed? No. There's no connection here. What the connection is that there's hard economic times. So people don't want to hire. They don't want to expand their business. What are they going to do? They're going to invest it. They're going to invest it into the stock market. They're going to maybe solo business owners, they have 1 or 2 employees. They're going to not hire their 4th employee. They're going to instead put it more into their retirement account. And where does that go? It goes into the stock market. So the stock market goes up as economic pain is starting to be felt out there and people are turning sour on the economy. It's counterintuitive to people. But that's also why we see the big names go up even more because they have a higher share of a diversified portfolio. Like if you buy a stock index, 30% of that goes to the FANGs or the Magnificent Seven. And so their stock price gets boosted disproportionately. Plus, am I going to buy like some local stock or some small stock, or am I going to put it into the blue chips? Am I going to put it into Coca-Cola, Exxon, some maybe big banking stocks or something like that? I'm going to put it into the big names, Tesla, Apple. I'm not going to put it into trying to pick stocks at a time like this. When we're going into recession and I think shit's about to hit the fan, I'm going to put it into the safer stocks and it goes into the Magnificent Seven and things like that. So this is totally in line with a pre-recession period. 100%. All right. So that's the kind of stuff I talk about here on the show. Let's go to this kind of secondary topic for today, and that's the SLOOS data. We don't get a lot of, we can't measure money supply directly because of the shadow banking system, and it's rehypothecated. It's, loans on using other loans as collateral 4 or 5 times in a row in a chain. And we just don't have any real high quality measures of the amount of money and the amount of rehypothecation that's going on. There are some efforts. I've seen several efforts over the last decade, but none of them are consistent, like data that comes out every month or anything like that. It's just one study here, one study there, trying to estimate it. But the SLOOS data here, the Senior Loan Officer Opinion Survey, this gives us an inside look. As good as we get. Actually, the best inside look is Treasury yields. That's the best. The bond market is the best look behind the curtain of the shadow banking system. But the SLOOS data is another way. So these are our 2 main ways. Of course, there's probably more that I'm not thinking of right now, but this is definitely something that you guys should pay attention to if you're not paying attention to it. So what they do is they go out there and they survey senior loan officers at most of the big banks and even medium-sized banks out there in the United States and foreign banks. But the headline number is always from just domestic banks here. And the main thing they ask them is, are you tightening lending standards or loosening lending standards? And secondly, they say, are you noticing stronger demand or weaker demand for loans? And then they break it out into different categories. So you have commercial and industrial loans, you have commercial real estate, residential real estate, and consumer loans. Those would be credit cards, those would be auto loans, things like that. Okay. And they also do like home equity lines. I think that's in the residential. But okay, so let's read through this a little bit and then we'll take a look. Actually, let's take a look at the chart first because it's a little bit counterintuitive on this as well. So the top half is tightening. Then the percent of banks that are reporting tightening net tightening. Like if 40% are saying they're loosening standards and 60% are saying they're tightening standards, that'd be net 20%, right, of tightening. That's what we're seeing here. So as it goes up, it got, during COVID, banks panicked, and nearly 80% of banks tightened their lending standards for this quarter. That must have been first or second quarter of 2020. Then the government came in with all these promises and guarantees, and so they rapidly loosened their lending standards down here, about 30% reporting net loosening. But of course, that didn't last forever, and it went back up. I also think if you look at this volatility that we've had here, this is where the juice for inflation came from, or the juice of CPI, because this period down here that was net loosening, that was when a lot of money was created. Anyways, so then it tightened, and now it's falling down again, but it is still tightening. Okay, so this is commercial industrial loans for the standards, and this is commercial industrial loans for demand. And you can see the percent over here again. And this is the percent of loan officers that are reporting stronger demand. So if you're negative, they're reporting weaker demand. Okay. And it got down to negative 60 roughly. And now it's back up to around negative 20. So 20% net senior loan officers are reporting shrinking demand. That's for commercial and industrial loans. But let's go back here and read through some of this. So January 2024, this is a quarterly report. Regarding loans to businesses, survey respondents, on balance, reported tighter standards and weaker demand for commercial and industrial loans to firms of all sizes over the fourth quarter. So even though that line is coming down, that's kind of tricky. And that can fool people a little bit, thinking, oh, it's getting better. But it's not. It's just the rate of getting bad is slowing. It's very similar to a year-on-year for CPI, right? Furthermore, banks reported tighter standards and weaker demand for all commercial real estate loan categories. For loans to households, banks, on balance, reported that lending standards tightened across all categories of residential real estate, other than government residential mortgages and government-sponsored enterprise, for which standards remained basically unchanged. So even those, they didn't get worse or tighter, but they didn't get any better either. Meanwhile, demand weakened for residential real estate loan categories. In addition, banks reported tighter standards and weaker demand for home equity lines of credit. Moreover, for credit card, auto, and other consumer loans, standards reportedly tightened and demand weakened on balance. While banks on balance reported having tightened lending standards further for most loan categories in the fourth quarter, lower net shares of banks reported tightened lending standards than in the third quarter across all loan categories. So that's what I was saying. It's not getting as tight. And remember, these are cumulative too. So the last quarter they said, oh yeah, net 40% of these senior loan officers were saying they're tightening. This time, it's going from that elevated standard, right? So now this quarter they ask who's tightening, and 20% are saying that they're tightening, on top of what they previously tightened over the preceding quarter. So it's cumulative. It's getting tighter and tighter and tighter all the time. Only when it goes past the zero line on those charts will it actually be getting looser. And we don't know exactly. It's not a qualitative thing. They're looking, or it is a qualitative thing. It's not a quantitative thing where you're looking exactly at the number of loans and all this stuff. It's just, are you reporting tightening standards and weakening demand, or what? Okay. January SLOOS also included a set of special questions inquiring about banks' expectations for changes in lending standards, borrower demand, and loan performance over the entire year. So this is a new special question. I think they've asked stuff like this before, but it's not an actual official part of the survey. Banks, on balance, reported expecting lending standards to remain basically unchanged for commercial and industrial and residential real estate loans, but to tighten further for commercial real estate. So CRE is having some problems right now. we have small regional banks being heavily exposed to this and already having problems. And the banks are reporting that they are expecting it to continue to tighten for commercial real estate. That's not good. Okay. Also, credit card and auto loans. In addition, banks reported expecting loan demand to strengthen across all loan categories. Okay, that's interesting. They are expecting demand to strengthen, but loan quality to deteriorate across most loan types. All right, let's go back into the charts here and blow it up. So we talked about commercial industrial loans. Let's take a look at commercial real estate. So this, you can tell back here in like 2013, they started breaking it up into different components. So you have all commercial real estate loans in black, but that stops right there. Construction and land development loans, non-farm, non-residential, and multifamily. They all pretty much move together. The multifamily is a little bit more volatile, it looks like, but they're coming down. However, this is still at 40%. So net 40% are tightening standards. If you go up to commercial and industrial, remember that was down. I think it was 14%. I'd have to look at the exact number, but I think this came in at 14%. So commercial real estate is in a much worse position, tightening much more than commercial and industrial. All right, here's demand. Slightly stronger demand, but still extremely negative, and not all that big of a bounce from about 70 to about, looks to be 50, 55. So not only commercial real estate are tightening, lending standards tightening faster, but the demand is also not coming back nearly as much as for the other ones. Okay, let's continue down here. Residential real estate, they have this broken down into a lot of different things. We're just going to cover this one on the left-hand side here. So black is all mortgage loans that kind of changed back here. Oh, wait, what's this year? Okay, so this is the sever point here. Okay, so it changed here, then it changed here again in between the charts, and now this is what we have. Let's take government loans, subprime. Overall, you can see the big tightening of standards during COVID, the weakening of standards in the aftermath with all the government assistance and guarantees, and then we are tightening here. But this is residential mortgages. This never really got as tight. Of course, the interest rates did that for us. So people just couldn't afford the higher interest rates. And so if interest rates stayed low, we probably would still see this going higher as well. So that was lending standards. This is demand. And you can see it came back a little bit here for demand for residential mortgages, fell again here. So got weakened, demand weakened even more. And it slightly turned around, but there's just not a lot of action here in the residential mortgage space right now. Okay, last one is going to be consumer loans. This is net tightening. See the COVID response, and then it tightened. And one thing I said on the Bitcoin Magazine Pro, which is the other outfit that I write for, and I'll take a look at that before we leave here. Don't let me forget that, guy. But I said that if you saw this, a spike down and it rebounding, we know that the CPI was going to be transitory. Because this area down below this line, that's what leads to CPI. That's expansion in lending. And that's credit expansion. I mean, not one-to-one, but that's a proxy for credit expansion. But it rapidly went the other way. And now it's in contraction, right? So we knew that it was going to be transitory the whole time. And I said it was going to be transitory the whole time. Okay, let's go down here to the demand for consumer loans. Of course, huge drop off for COVID response, but didn't get as high as any of the other things, and now is in contraction. It's very interesting, though, that this is a continuation of the trend. If you look during this post-GFC trend, it has been trending downward. I mean, you could draw a best fit line just perfectly downward through here. which I think is interesting because, we were going into recession or about to start the pre-recession process in 2019. We even had the repo rumble. We had rate cuts in 2019. We had rates falling. We had stocks going higher. We had the repo rumble in September. This was a pre-recession environment. Then we had COVID hit, and that kind of was out of left field. The market was not expecting COVID, but it kind of the response to COVID kind of short-circuited that whole pre-recession period. And I think it just delayed us by about 3 or 4 years. So now we're going back into this. This is a continuation of 2019 going into this pre-recession. And if you look at this, that kind of pops out at me at least. Okay, so that was it. Let's go back to my website, bitcoinandmarkets.com, and I will take a look at the questions here. Actually, I have to stop sharing to take a look at these questions. So thanks for joining me, guys. Ansel Lindner, Bitcoin and Markets, live stream here Monday, Wednesday, Friday, usually. I write at bitcoinandmarkets.com. I also write at bmpro.substack.com, and I was going to give you guys a little taste of that. There we go. So BM Pro, this went out today. Bitcoin flows fuel breakout as recession process continues. Talked about a lot of this same stuff today, but I break it down, make it into narrative form. We have the ETF flows. This image I thought was neat. So what I did is I overlaid the price onto the ETF flows. That's kind of cool. And talked about how price will affect flows going forward. Which comes first, price or flows? I think it's a chicken or the egg problem, but in reality, I think price will come first, then flows will follow. But that's that. Guys, check out bmpro.substack.com. All right. That's going to do it for me today. Hope you guys have a good rest of your evening, and I'll see you on the next one. Bye.